Good day, everyone, wherever you are. All right, it's 12 o'clock here on the East Coast. It is Sunday, all right, January 17th, and I am Phil Yaeger, and we're going to be doing statement of cash flow. Now, we're going to start off with the book. So I'd like everyone to turn to page 1B as in boy 20. 1B as in boy 20. All right. All right. And basically, we'll start with the first paragraph. All right. Now, no one's going to stop you and ask you, what's the objective of the statement of cash flow? All right. Well, basically, this is the objective. If you think about it, when you go into a bank to borrow money, doesn't have to be a bank, anybody who lends money. All right. They're going to ask to see a statement of cash flow because they want to see what generates the cash and where it's going out. So cash can come in from your day-to-day operations, or, all right, the second is the investing activities. The investing activity shows the acquisition and sale of assets, any asset for cash. It's got to be for cash. And the third section of the statement of cash flow is the financing activities, which also has an inflow and outflow, all right? And what do you put in financing activities? Well, if the company decides to issue stock, all right, common stock, preferred stock, the amount of cash they get is an inflow under financing. Also, anytime you go in and borrow money, all right, whether it's a note payable short-term or long-term, the bottom line is if you debit cash and credit mortgage payable, or you debit cash and credit note payable, notice you're borrowing money because the liability is increasing, all right? So that would be a financing inflow. Now, when you pay the mortgage, all right, when you pay the mortgage, you're generally going to pay off the debt, the principal, and also interest. Now, that's a transaction that involves two areas of the statement of cash flow. First of all, when you pay off the principal, any question? Any question? Do you have someone? All right. When you pay off the principal of the mortgage, all right, that amount is a cash outflow under what section? Anybody know? When you pay the principal. All right, let's not all yell at one time, okay? All right. Is anybody out there? Is my mic on? Where's the mic? All right. All right. Let's try this again. By the way, at the exam, guess what? You have to answer the questions. All right. So if I pay the mortgage, the principal, that is an outflow under financing. That's financing. But the interest that I pay comes out of operating activities. Do you see that? All right. So therefore, sometimes a transaction involves more than one section of the statement of cash flow. All right. Now, let's look at page 1B30. 1B30. All right. And it says right there on the top, financials. Well, it did say, all right.
You said 1B30, right?
I said 1B20. I'm sorry, 1B20.
Okay.
All right. I had too many drinks last night. I do apologize.
You don't drink.
1B20. Okay. Are you on there? All right. 1B20. All right. The third paragraph from the bottom. All right. It shows you the three sections of the statement of cash flow. And they are, you see that? The operating activities, which shows the day-to-day cash operating income and expenses. The investing activities, which shows the acquisition and disposal of non-current assets. All right. But remember, it's only the acquisition and disposal of non-current assets when you either pay cash or you receive cash. All right. Financing activities include the methods the company raises capital. Now, how can they raise capital? Well, they can issue their own stock, common or preferred, or they can borrow money. And the borrowing of the money can be on a short-term or long-term basis. So generally, if you see an increase like in notes payable, cash, that's a what? Financing inflow. If you see an increase in mortgage payable, if there's a cash involved, that is considered an inflow under financing. Now, it says here, there are two formats for the preparation of the statement of cash flow. And by the way, we're going to do large problems on both methods, okay? All right? And by the way, these large problems are, everything I'm going to say today has been on the exam, okay? And they follow the blueprints exactly, all right? The last exam had a statement of cash flow. In fact, just about every exam has a statement of cash flow as either a simulation, more simulation than anything, but also you could have some multiple choice. So there's two formats. They differ only concerning the operating activity section of the statement of cash flow. All right. Now, the first format is called the indirect method. All right. The indirect method. Now, what does the indirect method do? All right. It takes your net income, which is the day-to-day operations, all right, and converts it from accrual, because remember, net income must be on an accrual basis according to GAAP, but you have to convert that net income from accrual to cash. All right. And I'll show you how you do that. All right. And then the investing activities and the financing are the same under the indirect method. And the other method is called the direct method. All right. So under the indirect method and the direct method, remember, the only section that is different is the operating activities. All right. Now, what do we do on the direct method? Well, under the direct method, what we do is instead of going to the net income, by going to net income under the indirect, you're going to the revenues and expenses indirectly by going to the net income. Where the direct method, you're going to take every item on the income statement, starting with the sales, going down, and you're going to convert everyone, right? We're going to convert everyone. We're going to convert every item on the income statement directly. Sales, cost of goods sold, all right? And we're going to convert them from accrual to cash. All right? So, all right, that's basically the difference. Now, the next thing I want to show you is one other thing, all right? And it's on the top of page 1B21. Now, we used to say that what we're doing is we're doing the statement of cash flow to show what causes the change in the beginning cash and cash equivalents and to the ending balance of cash and cash equivalents. But now the statement of cash flow is this, all right? You are showing, all right, if you go down, let's look here, second paragraph. We now have a restricted cash category, all right, including a statement of cash flows for profit-making entities. Entities must either present restricted cash, as reported on the balance sheet, or on the face of the statement of cash flow, or disclose the amount in the notes of the financial statements. For example, the following is appropriate on the face of the statement of cash flow, all right? First of all, we're going to start with our beginning cash, cash equivalents, and restricted cash at the beginning of the year. All right. To that, we're going to add the net increase or net decrease in cash, cash equivalents, and restricted cash. All right. And when we take the beginning balance and add the increase or decrease, that gives us the ending balance of the cash, cash equivalents, and restricted cash. All right. Now, we know what cash is, right? It's this. All right. But, all right, what is a cash equivalent? A cash equivalent is something. I can't believe this. Hold on one second. All right. Now, what we're going to do is this. All right. We're going to determine the definition of a cash equivalent. Now, what is a cash equivalent? It's something that's equivalent to cash. For example, if I go into a bank and buy a certificate of deposit, all right, that's a cash equivalent. Does everyone know what a CD is? All right. That's where they say, you know what? If you deposit money in a bank for 6 months, all right, we will give you the enormous rate of 1 point. Now that's too high. 0.0008% interest. Isn't that great? 6 months, and that's what they'll give you. All right. Now, that's a cash equivalent. The CD is equivalent to cash. Also, money market accounts that you have at your stock brokerage firm or a bank, those are considered cash equivalents. However, when I spoke about the CD, all right, remember this. A certificate of deposit to be equivalent to cash has to have an original maturity of 3 months or less. All right. Does everyone see that? Let me show you where it says that. Does it say that? It should say someplace. But anyway, just remember, in order for a CD to be a cash equivalent, the original maturity must have less than 3 months. So let's assume I take out a certificate of deposit, a CD with a bank, and, all right, the original maturity was 8 months. But as of today, it's only 2 months until that CD matures. All right. Is this a cash equivalent? Yes or no?
Yes.
Anybody? Yes, it is. All right. Why is it?
It's less than 3 months to its maturity date.
All right. All right. Now, you fell into the trap because it says the original maturity, all right, must be what? 3 months or less. How much was the original maturity?
8 months.
Is that the original maturity? Yes. So is that a cash equivalent?
Then no.
No. Don't look at the number of months until it matures. Look at the original maturity date. If the original maturity date is 3 months or less, then it's a cash equivalent. All right. You see that? Now, if we buy a CD, all right, if we buy a CD and the original maturity was 2 months, this is the original maturity. If we buy a CD and the original maturity is 2 months, where would you show that statement of cash flow? Under what section? All right. Well, certificate of deposit, is that an asset? Yes or no?
Yes,
It
it's a
is,
cash
right?
equivalent.
All right.
Mhm.
So would you show it in the investing activity section?
Operating.
You don't show it any place. You want to know why? All right. Because it's equivalent to cash. So buying a CD with a maturity of 2 months, less than 3 months, is a cash equivalent. So that's like debiting cash, all right, for the CD, credit cash for the CD. All right. That's a wash. You don't show that on the statement of cash flow. You see that? All right. Because you're what? Cash is coming in. All right. It's going to come in. All right. It's a cash equivalent. And you paid cash to buy the cash equivalent. So therefore, from the standpoint of journal entries, it's like a debit to cash and a credit to cash. All right. Which means it's a wash. Don't show it on the statement of cash flow. All right. Any questions on that? All right. Great. All right. How many people are wide awake today? All right. Now, where would you prefer to be today? Here or someplace else?
Yeah.
Who said, what was that?
Here.
Here.
Of course. All right.
Here.
All right. Just think about this. After you go through this, and probably some of you going to the auditing, I would think. All right. You will be so full of accounting information that if you meet someone tonight, say, hey, let's have a discussion on accounting. Okay. All right. And if they don't want to, tell them they must have a discussion because accounting is the what? The language of business. Isn't it? Is that what they call it? The language of business. All right. Well, anyway, don't tell them that. They'll probably throw you out of the place you're in. All right. So remember, now, if there's any cash that's restricted, all right. Now, what is the definition of
Thank you for previewing the Yaeger CPA Review course materials. To learn more or to purchase the full course, visit YaegerCPAReview.com or click the link in the description.